And Microsoft's optimism for India's longer-term prospects comes amid a slowdown in economic growth. India has lowered its projection for the year to March 2025 to the lowest since the COVID-19 pandemic. Well, that's after consumers cut back on spending and government investment eased. GDP growth is now expected to come in at 6.4%, according to the official advance figure released close to 2 hours ago. This number is in line with the Bloomberg poll estimate, but sharply below the 8.2% growth in the previous fiscal year. The slowing growth may mean more pressure for the central bank to cut interest rates and help boost the economy. And joining us now to unpack those figures, Radhika Rao, senior economist, DBS Bank. Ms. Rao, before we get to whether the RBI will cut those interest rates, let's take a look at those figures. They are in line with DBS's forecasts as well as your downgraded forecast about 1 to 2 months ago, as well as RBI's also revised lower forecast. Is there a case to be made that this lower growth rate may be due to intended policy and therefore expected, managed, and within expectations?
Certainly, thank you. So I think what is happening with India's growth is that I would begin by saying growth expectations are aligning. You started the year with expectations. This is the year ending March 2025. That growth is going to be closer to more than 7%. As the months rolled on, you've really seen those expectations being tapered. So, for example, the central bank itself started at about 7.2%. Till late last year, they were still holding out at about 7%, and more recently, they have downgraded it to about 6.6%. We were in the 6% handle, and then we have been, successively bringing it down. So, official growth forecasts, in a way, are aligning on the lower end of 6 to 6.5% range, for example. So now, if this is the full year forecast, what's happening between the quarters? I would split the year in two halves. The first half of the fiscal year, which growth averaged about 6%, what you saw then is that there was a mix of idiosyncratic factors, things like there was an election. India faced general elections in the June quarter. The government obviously could not spend at that time, so they had to delay an increase in spending. That, coupled with the fact that there were significant weather disturbances, because of which you had some parts of the economy actually not functioning as well as it could have. And at the same time, the central bank also undertook macroprudential measures, credit growth to certain segments where they felt there were distortions. They tried to contain that. So all of these things put together certainly impacted growth in the first half of the year. Now, what's about the second half? We are in fact expecting a bit of a pickup in growth. Now, where's that going to come from? We do think that government has already begun to spend. I think they will not be able to spend everything that they're budgeted for, but they are trying to make up for lost time.
Ms. Rao, pardon me for cutting in. I suppose at this point, the question is, where is that growth going to come from? So if it's consumer spending that is weak, government investment that is weak, if government invests, that's one driver. The other driver would be trade and exports. And of course, concerns not just in India, but everywhere else because of the new incoming administration in Washington. And fears, given that Donald Trump has consistently called India a tariff king.
Certainly, to your question on where the growth will come from, I do still think that it's going to be very domestically driven. Exports are a big part of the economy, almost a quarter of overall growth. But if you see consumption and investment put together, that still makes up a lion's share. And I think that will be the major contributor to headline growth. So we expect rural demand, for instance, to pick up and government to also spend in the second half of the year, going into fiscal 26. You have asked a very pertinent question, what happens when the new administration takes over in the US? If we go back to 2016, 2018, that phase when Trump 1.0, you had seen the relationship being, frosty at times. There were some arrangements that India had a preferential window that was taken away, and it has not been restored yet. But I think if you see India's trade relations, they are actually quite aligned to the US rather than China. If we assume there's a broader trade skirmish between the US and China. So in that extent, India is better placed than many of its regional peers. But still, there is bound to be impact, especially on the trade front. So I would think that a 10 to 20 basis point of impact on growth could be seen. And certainly, India will have to also reciprocate in terms of bringing down some of the tariffs that the US might raise. So I would think there would be a bilateral agreement on certain crucial segments, at least to begin with.
And something that India can control. So interest rates, a lot of pressure in the last few months. Ministers certainly accusing the central bank of failing to cut rates. They've been held at 6.5% since February 2023. They say this is the time to cut, given the growth figures we're seeing now, despite persistently high inflation. What's likely to come out of February's central bank meeting?
A very important one. I think I should highlight that the Monetary Policy Committee, which is in charge of taking decisions on policy, is undergoing a big change in terms of composition. Terms of tenures of the governor has ended, so there's a new governor in place who took office in December. A new deputy governor is going to take office in January. The 3 external members in the Monetary Policy Committee also changed in October of last year. So it's quite a new MPC setup that you're looking at. They are weighing a lot of things, right? They're weighing what's happening to domestic inflation, what's happening to global, uncertainty, what the Fed is going to do, and what the currency is doing. So certainly weighing a lot of global as well as local factors. We do think that the balance will tilt towards a rate cut at the February meeting. And I think what will satisfy the central bank is that, yes, inflation, which had driven up because of food, is likely to come down. Growth has slowed down from last year, so that needs support as well. And then, you've got global uncertainty, but insofar as growth drivers are concerned, we do think it's going to be fairly domestic. So putting these things together, assuming that the new MPC will prefer a rate, a bit more dovish, we would think that a shallow rate cut cycle is likely to start in February.
We shall see what comes out of that central bank meeting. Radhika Rao, senior economist from DBS Bank. Thank you.